Hello, and welcome to another edition of the Symmetry Spotlight, where I break down financial topics and common investment questions with the goal of helping you make sense of the world of finance. So this month's topic is required minimum distributions, or what we call RMDs for short. We're going to talk about what they are, how they're calculated, and why planning for them is an important part of the retirement planning process. Required minimum distributions are a calculated amount of money that you must take from any of your tax-deferred retirement accounts, such as 401ks and IRAs. So the money in your 401k or IRA, it's all tax-deferred, meaning you don't pay taxes on that money until you take withdrawals from the account. And you might think, well, Nick, what if I never take any withdrawals from my accounts? Will I never pay taxes on that money? That thought process is exactly why required minimum distributions exist. So the IRS imposes these mandatory withdrawals to make sure that you do have to pay taxes on the money in those accounts, and you can't just sit there and let them grow forever and ever. The age that you have to start taking your RMDs depends on the year you were born. If you were born between 1951 and 1959, then your RMDs will start in the year that you turn age 73. If you were born in 1960 or later, then your RMDs start when you turn age 75. Now, your exact RMD amount is determined by a formula. Basically, you divide the fair market value of your account from the previous year by a life expectancy factor, which is provided by the IRS. So for example, let's say you had an IRA account that was worth $350,000 at the end of 2024. And this year in 2025, you are turning 75 years old. So the life expectancy factor provided by the IRS for a 75-year-old is 24.6. So 350,000 divided by 24.6, that gives us a required distribution amount of $14,227.64 for that person. In that example, for the 75-year-old who has an RMD of $14,227.64, they have the whole calendar year to get that withdrawal completed. They could take all $14,000 in one lump sum. They could spread it out on a monthly basis. They could take it out quarterly. The IRS does not care how you take your withdrawal. They only care that by the end of the year, you have taken that full $14,227.64. The life expectancy factors that are provided by the IRS, they are designed to increase your required distributions every year. So a 76-year-old with that same $350,000 IRA balance, they would have an RMD of $14,767.93. So a little bit higher than that 75-year-old. But if your retirement account is invested, it may be subject to fluctuations. So if we have a bad year with the markets, that lowers your account value, that could lower your calculated RMD. But generally, it's a good rule of thumb to plan on your RMDs going up over time. Why is it so important to know what your future required minimum distributions will be? Because they're treated as taxable income, and none of us like surprises when it comes to our taxes. So if we can look out ahead and get a ballpark of your future RMDs, that helps us plan for taxes. And in some cases, we identify changes a client should consider making right now in anticipation of this future taxable income. Some retirees are already taking withdrawals from their accounts. So when they reach the age when their RMDs kick in, they don't notice any difference since they were already taking money from their accounts. Like in my example of the 75-year-old with a $350,000 account. If they were already taking $18,000 from their IRA to cover their spending needs, then they don't have to take an additional $14,227. What they are already taking satisfies their RMD. So they notice no difference to their income or taxes. But some retirees are not taking money from their accounts, or the amount that they were taking was a lot less than their required minimum distribution. So they're put in a position where they're forced to take out a lot more than they actually need, which is extra taxable income for them. So, knowing what your future RMDs will look like is important so we can factor them into your retirement income strategy and for tax planning purposes. This is a big part of my conversations with retirement planning clients because in situations where we can see that their future RMDs are going to create challenges, we can get ahead of them. We have options like restructuring retirement contributions for clients that are still working, or looking at Roth conversions, or looking at qualified charitable distributions. These are all just some examples of strategies that we can leverage right now to possibly reduce the impact of the required minimum distributions. I'll touch on more of these in some future videos. For today, the goal was to cover what the required minimum distributions are, how they are calculated, and hopefully you understand it's something that needs to be looked at now and not just postponed until the age that you are required to do this. If you have any questions, please give me a call or send me an email. Otherwise, I look forward to talking with you again soon.